The following program was developed by Barclays American Mortgage Corporation. Since buying a home represents the largest investment most families will ever make, our goal is to help you make the right decisions. The program is provided as a service to you in the belief that the information it contains will help you understand and be better prepared for the process of buying and financing a home.
Oh, honey, this is a nice one. I wonder how much it is.
I don't know if we can afford a house that size.
How much can they afford? Where should they borrow? What type of loan should they get? Scientists who study and measure human behavior find that buying a home is one of the most stressful experiences of our lives. Contributing significantly to this anxiety is applying for the mortgage and then waiting for it to be approved. Much of the home buyer's unease results from not knowing what's going on. But buying a house doesn't have to be a stressful experience because there's an entire industry of professionals at your service. Builders, realtors, loan officers, loan processors, appraisers, and many more, all dedicated to helping you fulfill your dream.
Here's the one I like. I really love the yard. You know, Carol, we would really like to buy a house, and your firm sure has a lot of listings.
I'm glad you stopped by. Have you thought about how much of a house you can afford?
You see, the Pattersons are off to a good start. The first thing that needs to be considered when buying a home is how much can you afford?
Well, we've got a rough idea, but we're not quite sure how to figure it.
A good rule of thumb is your house payment, including real estate taxes, plus your other major debts, such as car loans, shouldn't be more than about 1/3 of your gross income. Of course, this will depend on the amount of your down payment and the specific loan program you select. A mortgage company will be able to give you a better idea once they know your situation.
Armed with that valuable information and the assistance of a professional realtor, Bill and Linda continue looking for a house they can afford.
Hello? Hello, Bill. What can I do for you?
Linda and I really like the house on Cedarview Lane and would like to see it again.
I'll be glad to show it to you again.
I'm on my way to pick her up at work. Can we meet you at your office in about an hour?
That'll be fine. I'll see you in a little while.
We really like the house.
Seems to fit our needs better than any of the others we've seen.
Sounds like you folks may be getting serious about this one. I think we should start looking at financing so you can make an offer.
That's good. I think we're ready.
As you're probably aware, banks and savings and loans offer mortgages, but I'd recommend you talk with a mortgage company. They specialize in mortgages. Now, I've worked with a couple that are very knowledgeable and provide excellent service. Here's a home buyer's kit from one that may open a few doors for you.
Open a few doors, huh?
Well, there sure is a lot of information here.
Yeah, there's even a list of mortgage terms we should know. Look at this, honey. Discount points. Prepaid interest paid at closing to the lending institution by the borrower.
Hello? That's great. Yeah, we were just looking at the kit that you gave us, and there are a lot of different loans. All right, that sounds good. We'll be there. Okay, bye. That was Carol, and she set up an appointment with the loan officer to talk to us about our mortgage.
That's great.
To this point, the Pattersons have avoided a stressful experience because they've been listening to the experts. Your realtor will be your best source for general information on financing. A loan officer from a mortgage company can guide you through the many complex products and find one that's right for you. As a team, they can help you make the right financing decisions.
Carol says that you have some questions about mortgages. How can I help you?
Well, with the information that Carol gave us, we have an idea of how much of a house payment we can afford.
That's the best place to start, carefully figuring what you can afford. Now you need to consider what type of loan is right for you.
But there are so many types of mortgages out there.
That's true. And the reason is because everyone's situation is different. I brought a videotape that'll give you some information on the types of mortgages that are available. Let's take a look.
These days, there are dozens of ways to borrow money and move into your dream home. But before you pick the type of loan best for you, ask yourself this question: how long do I plan to be in this home? Most families own a home for less time than they think. And as you will see, picking the right loan is often a matter of knowing how many years you plan to live in a house. Let's look at the lending market. There are three basic types of loans: FHA, VA, or conventional loans. VA loans are only for those who qualify from military service. FHA loans are for anyone, and they're backed by the government. They require lower down payments, and the loans are assumable if you ever sell your house. It lets you buy a home sooner since less cash is required. The amount you can borrow is limited, however. Conventional loans, on the other hand, can be used for larger amounts, and there are a variety of them from which to choose. So, talk it over with a loan officer at a mortgage company. A major decision is whether you want an adjustable rate or a fixed rate loan. An adjustable rate means the interest rate and your payments can go up or down. A fixed rate means you know your loan payments will not change because you were charged a flat interest rate for the life of the loan. This can help you budget more accurately. A fixed rate loan will generally require a smaller down payment than an adjustable rate loan. Let's look at some options with fixed rate loans. There are several fixed rate options that allow you to have lower monthly payments in the beginning. The payments gradually increase during the early years of your loan and then remain fixed. These types of mortgages are called GPM, Graduated Payment Mortgage, and GEM, Growing Equity Mortgage. GEM is generally for a period of 15 years, whereas GPM can be for 15 or 30 years. There is another way to keep your payments down for the first few years of your loan. It's called a temporary buy-down. Temporary buy-down requires a buy-down fee to be paid at closing in order to reduce the payments for the first few years. This most often occurs with the purchase of a new house. There is also the option of a temporary buy-down without the buy-down fee. It lets you make a small down payment and also reduces your payments for the first few years and gives you the head start to be able to afford a bigger house now. So, if you expect pay raises down the road, the temporary buy-down, the GPM, or the GEM could be right for you. You can also pay additional discount points for a lower interest rate. That's called a permanent buy-down, and it reduces your payments for the life of the loan. One discount point is 1% of the loan amount. This would be $750 for a $75,000 loan. The more points you pay, the lower your interest rate will be. If you plan to live in the home more than 6 or 7 years, then a permanent buy-down might be a good idea. Another type of fixed-rate loan is a fixed-rate plus mortgage. Some people also call it RIM for Rate Improvement Mortgage, or ROL for Reduction Option Loan. With this loan, if interest rates drop 2% or more, the interest rate on your mortgage can be reduced without having to go through the costly procedure of getting another loan. Naturally, this reduces your monthly payment for the life of the loan. As you can see, there's a fixed mortgage to fit almost any situation. The primary thing to remember is, if you like the security of a fixed interest rate, there are options designed to fit your needs and help you buy the home you want. So talk with your mortgage company. They will guide you through the numbers and options and help you pick the right loan. Now let's look at the other major category of loans known as adjustable rate mortgages, or ARMs. Once again, the amount of time you're going to be living in your home is important. ARMs are good for families who know they will live in a home for only a few years, or families who expect their income to grow. This is because the beginning interest rate on an ARM is less than on a fixed rate loan. This means your monthly payment is lower, and you might be able to afford a larger house. Of course, you're saying, that's great, but then they sock it to you when the rates go up. Well, the rate on an ARM can go higher than a fixed rate loan. However, there are caps or ceilings to prevent the rate from going sky high. Actually, there are two caps. a lifetime cap or limit on the amount that the interest rate can go up during the life of the loan, and a periodic cap on the amount the interest rate can go up at any one adjustment. In some cases, there may be a payment cap instead of a periodic cap. Different ARMs have different adjustment periods. Adjustments can be as often as every 3 months or as infrequent as every 5 years. There's also a possibility of deferred interest on some ARMs. This most often occurs if there is a payment cap and payments are not sufficient to cover the interest on the loan. This is called negative amortization or deferred interest. When this happens, the interest not covered each month is added to your loan. It's something you need to be cautious of because if you decide to sell your home, the balance on your loan could be more than the original balance. So, if you're considering an ARM loan, be sure to ask your mortgage company about it. One more point to cover on ARMs is how interest rates are figured. The most common indexes used are the yield on U.S. Treasury bills or a cost of funds index. Be sure to ask your lender which index he uses and how it works. Basically, the lender takes the index and adds a margin to come up with the interest rate. The margin remains fixed. So, if you think interest rates will be relatively stable, and if you'll be in the house only a few years, an ARM is worth considering. But making an accurate comparison of ARM options can be difficult because there are so many differences in the margins, indexes, and interest rates. Some lenders have computer programs that compare different ARMs for you. Armed with this comparison, they can help you decide which mortgage fits your needs. Once you've decided between FHA, VA, or conventional, fixed or adjustable, you'll want to consider whether you want a 30-year loan or a 15-year loan. Now, you may think, if I borrow the money for 15 years, I'd never afford the payment. Many people are surprised to learn that the payment may only be $60 to $70 more per month on a $50,000 loan, and the amount you save in interest is unbelievable. To start with, the interest rate on a 15-year loan is usually less than the 30-year rate. So just think, if you borrow $50,000 at 11% for 15 years, you'll save nearly $76,000 in interest over a similar 30-year loan. Another option is the bi-weekly payment mortgage. Because you make the payments every 2 weeks, the loan is actually paid off in about 20 years. As you can see, there are many mortgages available today. Once you've given them consideration, you need to discuss your particular situation with your mortgage company. They will use computers to analyze your needs and select the mortgage that is right for you. Once you have a signed sales contract, you will apply for a mortgage. Be prepared to give detailed information on your income, savings, assets, and debts. The same basic information applies for most loans. Less information might be required if you have a substantial down payment. Many times, the lender will have a checkoff list that you can use. Let's take a look. First, you'll need the sales contract. You'll also need to provide information on your employment and salary. If your income is mostly commissions or you're self-employed, your complete signed tax returns for the last 2 years are needed. Checking and savings balances and account numbers are needed, as well as the make, model, and value of all cars you own. Value of life insurance, as well as stocks and bonds you own, is also needed. You'll be asked to provide the names and account numbers of all charge accounts and installment loans, such as car loans, along with the monthly payments for each. If your down payment includes a gift, say from your parents, then they will be asked to complete a form letter saying you don't have to repay the money. Also, your parents' account might be checked to ensure money is available. If you are self-employed, you can expect the process to be much more detailed. The key to applying for a loan is being prepared. As you have seen, the checkoff list is very valuable. If you don't have one, ask for it. Once you've applied for the loan, relax. The mortgage company will check out all the information. Generally, it will take 3 to 5 weeks. It could be more or less time depending on your needs and market conditions. One last point. Consider your mortgage company as your partner. Both you and they are trying to get you the loan. If they ask for additional information, get it to them as soon as possible. Remember, successful home ownership begins with a dream and ends with a number of people working together to make it a reality.
What do you think?
There's a lot more choices than we realized.
What do you think would be best for us?
Well, we can take a look at your situation and see which one would fit your needs best. Let's begin with a few questions, and then we'll see what the computer has to say.
As you've seen, things are still going smoothly with the Pattersons. There are many mortgage options from which to choose. The important thing to remember is talk it over with your mortgage company before you make a decision. Once the Pattersons have considered the financing, they're ready to make an offer on the house.
Now, as you can see, the sales contract says you're offering $88,000 on the property at 3939 Cedar View Way. It shows what items are to remain in the home, and it spells out the obligations of the buyer and the seller. And it is subject to your getting a fixed-rate loan.
That sounds fine.
Okay, sign here, and once the owner signs, we've got an agreement.
And then we can meet with Chris Parker at the mortgage company.
One of the most commonly asked questions about home loans is, why does it take so long for the loan to be approved? Well, it's a complex process. The buyer has to provide a lot of information. The mortgage company has to verify it. As you'll see, even when the buyer comes in well prepared, there's a lot to be done. Let's follow the process as the Pattersons apply for their loan.
You've decided that the 15-year fixed-rate mortgage would be best.
Mm-hmm. Here's the information on our employers and salaries.
We've also got information on our checking account, savings account, the Visa account, MasterCard, and car loan. And this is a statement on our stock account.
Hold on a minute. Boy, you folks are really prepared.
We have everything that was on the checklist.
That's great, but I can't write that fast. I'll tell you what. You need to start filling out some forms and sign them so we can start obtaining information. These are employment verification letters. There's one for each of you since you both work. This is to verify your bank accounts, and this is to verify your rental payments. Why don't you start filling those out while I transfer your information to the application form?
No stress here. You see what being prepared can do for you? The next decision is whether to lock in your interest rate and discount points by signing a form. Some companies allow you to do this anytime between the loan application and when the closing is scheduled. When you lock it in, you have an interest rate and points you can count on for a fixed period of time. The lock-in period varies from lender to lender. Until you lock in, the interest rate and discount points will change with the market until closing. Be aware that interest rates and discount points change almost every day, so consider this decision carefully.
All right, now, I need a check to cover the credit report and appraisal.
All right. Here you are.
Okay. Here's a good faith estimate of the closing costs. It'll give you a rough idea of the cost of closing the loan and transferring the title. It'll also include the discount points, the origination fee, and the mortgage insurance. Oh, and this is a settlement cost handbook. It explains the closing costs.
If your down payment is less than 20%, private mortgage insurance, or PMI, is generally required. It protects the lender from some of the loss in the event of foreclosure and makes it possible for you to buy a home with a smaller down payment. FHA loans require a mortgage insurance premium, and VA loans require a funding fee.
I'll also send you a truth in lending statement. This includes an APR, or annual percentage rate. Now, this is a calculation of the interest based on the mortgage, the closing costs, and the discount points. Therefore, the APR will be higher than the interest rate of the mortgage alone.
Is there anything else?
Well, everything looks good. We'll keep your real estate agent advised of every step. If you have any questions for me, don't hesitate to call.
While the Pattersons head home, the mortgage company is going to work. First, a check of their credit is made. This will take about a week.
This is Kathy Bennington. I need an appraisal for 3939 Cedarville Way.
The appraisal is ordered while the signed form letters are sent to collect information on such things as rental or mortgage payments. Letters are also sent to gather information on checking and savings accounts as well as to verify employment. During this time, you may have to provide more information.
Hello?
Hello, Linda. This is Chris Parker. How are you?
Hi, fine. Did we get the loan?
Well, things are coming along, but I have a couple more questions. The credit report shows that you're making payments to First National. You didn't mention that on the application. Can you tell me about that loan?
Oh, that was the loan on Bill's car. We just paid that off.
Okay, well, I'll need a letter from the bank saying the loan's been paid off.
Okay, I'll call right now. Bye.
Don't panic. Things come up. Most can be cleared up with more information. Be truthful. Never try to hide information, and try to provide information requested as quickly as possible. As you can see, there's a lot going on. There are things that can cause delays. Some are not so apparent to the buyers.
This is Kathy Bennington. Bill Patterson has applied for a mortgage with us. I sent you an employment verification for him last week, and I haven't heard anything. I was wondering if you had received it. Oh, you didn't? Well, I'm sorry. I'll send you another one. Could you please return it to me as soon as possible?
At this point, there are a lot of people working to help get this loan, and before the process is complete, there'll be even more. The loan processor at the mortgage company, all of the people that have received verification letters, the credit bureau clerk, and the appraiser. The appraiser will photograph the property, inspect it, measure it, and compare prices of other comparable properties that have recently sold in the neighborhood to determine a fair market value. When all of the letters and information, including the appraisal, arrive at the mortgage company, the entire file is turned over to an underwriter who reviews everything and determines whether the loan should be approved. Underwriters are highly trained professionals with many years of experience. If private mortgage insurance, PMI, is required on the loan, it'll be given to an underwriter at the PMI company at the same time.
Hello.
Hello, Bill. This is Carol Thompson. I've got great news for you. Your loan has been approved.
Oh, that's wonderful. Can we close before the end of the month?
Well, how about the 28th?
The arrangements for closing are made by the realtor, loan officer, and the attorney, or in some cases a closing agent. There are many things that need to be done. A survey is made to confirm the boundaries of the property. There's also a termite inspection. At some point, an attorney goes to the courthouse to make sure the title is clear. This ensures that the seller actually owns the property and there are no liens. Most mortgage companies will require title insurance to protect themselves in case some long-lost relative shows up and claims to be the real owner of the house. As an owner, you may want title insurance to protect yourself. Ask your lawyer. Besides patiently waiting, the only thing the Pattersons need to do is buy homeowners insurance. The policy is needed at closing.
Hello, Linda. This is Carol. I wanted to let you know that everything is finished on your loan and we are ready to close.
All right, I'm going to pass out these closing statements, and you'll see in detail who pays for what. Please sign right here.
The closing is a ceremony of sorts, where you sign the papers that finalize the loan and transfer the property from the seller to the buyer.
Congratulations, you two. You're homeowners.
Remember, when you start looking, talk to a mortgage company. Get their advice on the types of loans and how much house you can afford. Most of all, relax. Professionals in real estate and mortgage lending are experts at fulfilling a dream.
Oh, this house looks beautiful, and it sure beats paying rent.
It sure does, hon. Buying this house is the smartest thing we've ever done.